presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak Market Update. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for tuning in today. I'm going to talk about the markets, what happened today. One thing that I'm really looking at that I think will give us some idea that the Fed will back off is inflation and jobless claims. We have to have jobless claims going up. We're at a 50-year low, and until people start to feel uncomfortable with the job prospects, they'll continue to spend. And gas prices, is there an end in sight? We'll take a look at that. China and the US Treasuries. The world is cutting back on buying US Treasuries. That's something that's interesting. The housing market, the next shoe that is going to drop in the housing market. We saw a tremendous amount of price increases in the price of homes. What is next to come? I'll talk about that. Then we'll take a look at the technical analysis. We're sitting at a critical point today as the market closed. I'll show you the charts and we'll go through those. Then we'll also take a look at the market, where we are as far as the economy is concerned, and then the outlook to go ahead. Let's start with the jobless claims. You can see the seasonally adjusted claims are sitting right here. Weekly moving average is, we are still starting to come up a little bit, but not much. If you look at the insured unemployment, it still continues to come down. And we are sitting at a very, very low point in this right here, right now. And until we see this number start, seasonally adjusted initial claims start going up, when we see adjusted unemployment rates going up, and they are the prior year, this is where we were last year, this is where we are now, and we have to see this start to go up. That's when we see the economy is really slowing. As the old saying goes, if it's a slowdown in the economy when the neighbor loses a job, and then it's a recession when you lose your job. So people are really not looking at anything right now except the savings that they have from COVID that they did not spend. They're still spending out there. They're still going and traveling. The planes are full. The hotels are full. So until we see a slowdown in consumption, which we're starting to see now, we are starting to see the first signs of that. We saw consumer sentiment numbers come out from the University of Michigan last Friday. They were some of the worst numbers we've seen on record. We saw consumer sentiment come out again today, and that is also down. So people are starting to get nervous with the economy. When is that going to change? We'll have to wait and see. When will that translate to lower consumption and the slowdown in the economy? As you've heard me say, that the U.S. economy is like a super tanker. If you put on the brakes, it does not stop like a sports car. It takes a long time for it to show up. Prices for gasoline still continue to go up, but we're starting to see some little drop right here. Last couple of days, we've backed off a little bit. Now, there was some hope that we would get more oil from Saudi Arabia and the United Arab Emirates, the UAE. President Biden is headed there. But there was a conversation today that we saw between Macron, the president of France, and President Biden, who is in Germany for the G7 meeting. And Macron was saying that he has talked to MBS. That's Mohammed bin Salman, the head of the de facto ruler of Saudi Arabia. He's the crown prince. And that he only has about 100,000 barrels extra. And so did Al Nahyan, the head of the UAE, say the same thing to Macron, that he's only got 150,000. That's what Macron was trying to tell the president, that there's not a lot of excess capacity out there. Now, there is an OPEC meeting coming up later on this week where OPEC might decide some countries are unable to produce as much as they have been allocated for the quotas, like Libya and Ecuador, Nigeria and Ecuador. So we could see Angola, Nigeria, some of their quotas that they're unable to meet. The Saudi Arabia said, look, we're not going to raise production, but we are going to raise production enough to fill the quotas that they're unable to fill. That might be something that we might see coming out of the meeting. Number of petroleum refineries, that's starting to move up a little bit. You're looking at treasuries, that is the interest rates. And you can see that the largest holder of U.S. treasury bonds are Japan, and then China, and the United Kingdom. That's in that order. You can see that Japan last year had $1.276 trillion. Now they're down to 1.18. You can see China, which was at nearly 1.1 trillion. They're down to about 1 trillion. So they've sold nearly $96 billion of bonds, or they're buying less bonds. Same thing as the picture. The only one that has increased is the United Kingdom. They went up from 431 to 612. They bought more bonds in the last year or so. So you're seeing this shift where some of the large bondholders like China and Japan are starting to lower their holdings. Housing market, you can see that interest rates have raised payments by about $600 a month. That's what they've already gone up. This is monthly payments and the 30-year mortgage. This is the monthly payments. You can see that there. And you can see the rates have come up. This is in red right here, dramatically. People were saying last year that, look, prices are up. That's okay because my payment is still low because interest rates were so low. But now prices are higher, interest rates have come up, so the payments have gone up, and that will be a slowdown in the housing market. But I feel there will be a bidding war. Where? Not to buy homes, but to rent homes or rent condos. I think because prices of homes have gone up so much that we are going to see rents going up, and people are going to try and rent these homes, and the landlords are going to ask for more rent. And if that starts to happen, it's going to creep into the CPI or the Consumer Price Index, because shelter or interest rates or rents are a big part of that. We'll have to see that. You can see among renters, widespread renters, low-income households, and households of color. That's where we are seeing the pressure starting to build. Looking at the technicals, markets look like this is a 60-minute chart. It's not a long-term chart where each one of these bars is 60 minutes. Each one of these green line vertical lines that you see is 60 minutes of trading. That's what it is. This is the 23rd, this is the 27th. We hit a high today on the 28th. This magenta line is the 200-day, 200-hour moving average. We came and kissed it and fell right off of it. Now we're sitting at the 50-hour moving average, which is 38.19. We closed at 38.21 today. So we are right at this. Looking at a longer-term chart, this is a 10-year note chart. I'll come back to this in a second. Here's the daily chart. You can see we gapped up on Friday. This is where we were. This is the high on Thursday. This is low on Friday. And you see this opening right here. That is a gap on the charts. That is at 38.21. We closed at 38.21 today. So we're sitting right at this gap. If we gap lower tomorrow morning, that will leave what is called a 3-day island bottom, where we gapped up and gapped down. That would not be good. Usually a turning point in the market. Then the next support, we have a little bit of support. I go back to the 60-minute chart right around here, which is around 3,800, a little bit more around 3,750, and then right around here, 3,720. These are some short-term support areas, but if we break substantially below 3,700, probably headed back to the 36 number, and that's what I'm looking at. So we could, as I've said for the last few weeks, we could bounce around here on the daily charts. These are the daily, each bar is 1 day of trading instead of 1 hour of trading. Looks like we have made a fifth wave low, but that is not confirmed yet until we break out above 40.43, which is the 200, which is the 50-day moving average. That's why we could bounce around for a couple of months. That would not be surprising. Looking at the Nasdaq, again, we gapped up on Friday. This is the gap. We filled it today. There's a little bit more space right here on the gaps, and if we fill this gap right here, then we're probably headed back to the 10.5. We closed at 11,181, about 600 points above that. Technically, the market's still weak. We need to break above the 50-day moving averages for me to get excited that we have made a bottom. As you've heard me say, you want to see a bottom in the rear view mirror. You want to see the bottom in the market. Market has already gone up, breaking up above substantial resistance areas. That's when we can see we've made a bottom. Until then, everybody's guessing where we're headed. Looking at the 10-year interest rates, here is the 10-year note. We went up, hit the fifth wave, came back down, and this is a 2.99. This is a 50-day yield on the 10-year note, or interest rate on the 10-year note. When rates go up, bonds go down. 3% is the number we were watching. We're at 3.2 today. So Rates need to break down below, but they will not go down until we see inflation going down. That's the way I'm looking at the charts today. Oil got above the 50-day moving average today at 110.23. We closed at somewhere around 111. That's where we saw a close in the market. So if we can stay here 50 days around 115, 20-day is about 115, that's going to be resistance. But if we break substantially below this, we could be headed back towards the 200-day. But oil prices have to stabilize. Oil feeds into inflation. Inflation has to stabilize. When inflation stabilizes, the Fed can take the foot off the brake. Right now, we don't have any confirmation of any of those things happening. We're seeing first signs of it, but in the next couple of months, we're going to see that. Market, we're still at a chance where we're going to see 50% chance of a recession. I still see that happening. Is it going to be a mild recession? Is it going to be a deep recession? No one knows. That's why you have to have the right allocations in your portfolio right now. You have to have the right risk number where you know the worst case, best case scenario over the next 6-month period. If you don't know that, give us a call. We'll be more than happy to help, or go to compak.com and we will do that work for you absolutely free, so you have some idea of how much risk you have in your portfolio. You should have raised some cash in your portfolios already. Over the last 3 months, you should have been selling the rallies, as you've heard me talk about on the daily broadcast on Market Wrap with Mo. You can get the app. Just go to the App Store, type in Market Wrap with Mo Ansari, and you'll see the app show up. It's free. Download it, and you'll get the daily broadcast that I do every day. For the week ahead, I think we're still in a choppy market. How oil prices go, how interest rates go, until we get clarity, we're going to just bounce around. We went up sharply on Friday, came down a little yesterday, came down more today. Now we're sitting at the gap at support. If you gap lower tomorrow, that's not good. If you can fill the gap and start moving back up again, that would be a good indication. Those are my views. Those are my thoughts today on the 28th of June, 2022. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors, because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.